Hello, team. This week we're going to talk about Chapter 3, Analyzing and Recording Transactions. The chapter outline, we're going to discuss and describe principles and assumptions and concepts of accounting and the relationship to the financial statements. We're going to expand on the accounting equation, which we learned about in the last chapter. We're going to talk about initial steps in the accounting cycle. We're going to analyze some business transactions using the accounting equation. And we're going to use journal entries to record transactions and post to the T account as well as prepare a trial balance. So to look at concepts and overarching, we want to see who are the people in charge of designing the accounting standards. In this case, it's the Financial Accounting Standards Board, which is an independent nonprofit organization that sets these rules. And the rules they set are called GAAP, or Generally Accepted Accounting Principles. And these are designed for both public and private sectors of business in the US. So GAAP is concepts and standards and really rules on preparation and presentation of financial statements. Make sure that every company or business is on the same page when it comes to presenting their financial statements. That means no one business has an advantage over the other. And we're comparable from one business to the next business. So in the US, it's called US GAAP. International rules are called International Financial Reporting Standards, or IFRS. Some companies that operate on a global scale are allowed to report in IFRS. And publicly traded companies ultimately reports to the SEC, or Securities and Exchange Commission, and they are regulated on what rules and presentations they have to do as well. So let's talk about the conceptual framework. There's a lot of principles that we have to abide by, and these are overarching principles and ultimately guide what GAAP comes up with. So we have the revenue recognition principle, and this directs companies to recognize revenue in the period in which it is earned, whether it be product or service. If it is a service, in the period it is provided. Expense recognition or matching principle. This means that the expenses that are associated with the revenue are recognized in the same period as the revenue. We have the cost principle. This states that company owns or controls assets must be recorded at value of the date of acquisition. This is also known as historical value. We have the full disclosure principle. This means a business must report any activities that could affect the financial statements. We have the separate entity concept. This prescribes that a business may only report activities on its financial statements that are specifically related to the company operations, not those activities affected by the owner personally. Being conservative or conservatism. If we're uncertain about it and we're making an estimate, we have to estimate in the side of caution. That means we want to avoid as much error as possible. So for example, simplistically, being conservative means we would recognize a lower cost or market on inventory, which means we recognize inventory at a lower value than we normally would, or the lowest value we can. Monetary measurement concept means a monetary unit by which we value the transactions. Usually it's in USD or US dollars in the US. A going concern assumption. This assumes that a business will continue to operate in the foreseeable future. If a business is not able to operate in the foreseeable future, it triggers another type of accounting, which is above and beyond the scope of this course. We have the time period assumption that states company can present useful information in shorter time periods. And we talked about this, such as years, quarters, or months. So let's talk about the hierarchy. Ultimately, the SEC enforces GAAP, and they're the highest level. FASB sets GAAP. And then we have the GAAP accounting standards. And we have all the various principles falling underneath it. We talked about this in the previous chapter. This is an accounting equation or fundamental accounting equation. Assets equals liabilities plus owner's equity. Remember that equity can be converted into common stock as a title or retained earnings, depending on if it is a corporation. Okay, the basic components of even the simplest accounting system are accounts and general ledger. An account is a record showing increases and decreases to assets, liabilities, or equities. A general ledger is a comprehensive listing of all the company's accounts with their individual balances. We record transactions in the general ledger using a double entry accounting system. In other words, for every debit we have to have a credit. This also falls into the fundamental accounting equation to balance. So we must at least have two accounts, one with a debit and one with a credit balance to be impacted. So in order for companies to record myriads of transactions, they must have each year, there is a need for a simple but detailed system. Each account has split into right side and left side, debit or credit balances, as you see at the bottom. A debit balance or debit entry is the left side and a credit entry is the right side. The ending balance is a difference between the two of those. Below is a T account. All right, I've highlighted this. You should memorize this. Assets equals liabilities plus common stock minus dividends plus revenue minus expenses. This is a little bit more detailed than we discussed previously. So normally assets have a debit balance and liabilities and equity have a credit balance. So if you debit an asset, it increases its value. While if you debit a liability or equity, it decreases the value. Conversely, if you credit an asset, it decreases the value. If you credit a liability or equity, it increases its value. So going through in more detail, an asset increases with a debit and a normal balance is a debit. A liability increases with a credit and its normal balance is a credit. Common stock increases with the credit, its normal balance is a credit. Dividends increase with the debit and its normal balance is a debit. Revenue increases with the credit and its normal balance is a credit. And expenses increase with the debit and its normal balance is a debit. All right, stockholders' equity is the owner's stake or stockholders' investment in the business and earnings. There are two components of equity. There's contributed capital, that's what money the business owner put in or their interest in the business. The business uses this money to grow and develop the business. And then you have retained earnings. This is income that has been earned by the business, that has been paid out in the form of dividends to stockholders. So getting into more detail on equity, we have contributed capital and retained earnings. Contributed capital is primarily common stock or what investment investor put in. And retained earnings could be revenues less expenses less dividends. So dividends are what are paid out to common stockholders. So let's talk about the various accounts. We have cash or cash equivalents, which includes paper currency as well as coins, checks, bank accounts, money orders. We have accounts receivable. That is money that is owed to the company, usually from a customer. We have inventory. These are goods available for sale. They're an asset until they are sold. We have supplies. Specifically, these are office supplies, pens, papers, rulers, staples, and these are considered an asset till an employee uses them, at which time they lose their economic value and you have to expense them. We have prepaid expenses. These are items paid for in advance, such as rent and insurance. Consider an asset until you use it. We have notes receivable. Very similar to an accounts receivable, but usually this is a longer term instrument and includes interest. We have equipment. These are desks, chairs, computers, trucks. This is long-term value, which means we'd usually depreciate it over time. So we expense it over time. We have buildings, machinery, and land. All of these are considered long-term assets. We depreciate buildings and machinery, but not land, because land never loses value. All right, let's look at some pictures of some cash. I think we've all seen this. We have buildings to the right. We have inventory down below. And then we have equipment. All right, let's look at some liability accounts. We have accounts payable. This is money we owe our suppliers or vendor. That hasn't been paid yet. Notes payable, similar to notes receivable. These are usually longer term instruments, as in they may be a year or greater than a year, and usually they have interest applied to them. Basically, think of it as a loan until it's paid. And then we have unearned revenue. This is basically customer advance payments. So if you ask a customer to pay you $100,000 in advance for a product or service and you haven't supplied it, it is considered unearned revenue and a liability, because ultimately, if you don't provide that product or service, you're obligated to return the funds or pay it back. So let's look at the financial statement and accounting equation interactions. So we've already looked at assets equal liabilities plus owner's equity. Then we added in assets equal liabilities plus contributed capital and retained earnings. And then we got in even greater detail, and we have assets equal liabilities plus contributed capital plus beginning retained earnings plus net income minus dividends. And then finally, we have assets equal liabilities plus contributed capital plus beginning retained earnings plus revenues minus expenses, which is net income, less dividends. All of these appear on the income statement, statement of stockholders' equity, or balance sheet. So, in question EA11, let's identify whether these are naturally debits or credit entries. So, a cash increase is a debit, because cash is an asset. A supplies decrease is a credit, because supplies is an asset, and to lower it, it's a credit. Accounts payable increase. Accounts payable is a liability, a normal credit balance. To increase it, you credit it. Common stock decrease. Common stock or owner's equity is normally a credit balance. If you're decreasing it, it would be a debit balance. Interest payable decrease. Interest payable is normally a liability, so to decrease it, you debit it. And notes payable decrease, again, a liability account, so a decrease would be a debit. All right, let's talk about the accounting cycle and steps within it and how we record activities and events in the financials. The process occurs over one accounting period, and the cycle will begin again in the following period. So this period could be either a month, a quarter, or a year. All right, the first 4 steps. We identify and analyze the transactions. We take the information from the original source or activities we're doing, and we use this information in order to generate financial data. We record this transaction from step one and organize it into a comprehensive record for every company transaction. Then we post it, and we post this transaction from the journal during a period it moves into the general ledger. And then we take this information from the general ledger and transfer it onto a document showing all accounts and ensures debits equal credits. This is what we say is the unadjusted trial balance. So here you see the total accounting cycle. We discussed the first 4 steps. The next steps, which will be touched on in future chapters, is step 5, adjusting entries. Step 6, prepare adjusting trial balance. 7, prepare financial statements. 8, closing entries. 9, prepare post-closing trial balance. 10, prepare reversing entries as needed. Okay, now we're going to talk about the general journal. And the general journal lists activities in a chronological order. So, in this transaction or event, we record financial information presented on financial statements. It comes from the original source, as we said in step number 1. The journal is where we prepare and find and record all these transactions in a given time period, such as daily. So here we see a transaction, an example of a transaction, I should say. We record these in chronological order. If we're doing it daily, that just makes sense. And we have specific accounts. So here we have accounts receivable and cleaning revenue. So the customer, we provided the cleaning service to a customer. So for revenue, we credited $200. And they didn't pay us in cash, they paid us on account. So we debited accounts receivable by $200. All right, here we see an example of a trial balance. These balances will come from the general ledger. Basically, we're listing each account into the trial balance. And this is to make sure that for every transaction we did, our accounts balance, the debits equal the credits. Okay, the first step in the accounting cycle is to identify and analyze transaction. Again, we're pulling it from the original source to be evaluated for its financial implications. We take the information contained on this original source and how it affects the statements. If it does affect the statements, then the company then must analyze the information and see how we put it into the financial statements. One task is to determine the value of the transaction. Sometimes this is obvious and other times it is less clear. So you're an accountant for a small computer programming company. You must record the following transactions. What transactions or values do you think you use? So here we have the company purchased a secondhand van to be used to travel to customers. The seller told you they believe it is worth $12,500, but they agreed to sell it to you for $11,000. You believe the company is a really good deal because the van on Blue Book is $13,000. B, your company purchased its office building 5 years ago for $175,000. Values of real estate have quickly risen in the last 5 years, and the realtor told you that it's worth $250,000 today. Since the building is now worth $250,000, should you increase the value on the books? Your company has performed a task for a customer. The customer agreed to a minimum price of $2,350. But if they have absolutely no issues, they will, for programming for the first month, they will pay you $2,500. So what value do we record this at? And the owner of the company is almost 100% sure that they'll get the $2,500. D, the owner of the company believes most valuable asset for his company is his employees. The service the company provides depends on having intelligent, hardworking, dependable employees who believe they need to deliver exactly what the customer wants in a reasonable amount of time. Without the employees, the company wouldn't be would not be as successful. The owner wants to know if she can include the value of her employees on the balance sheet. So on A, we record the purchase at $11,000, which is the historical value. The only time we would recognize an increase is when we sold the van. Again, with the building, we'd recognize it at its historical value. We'd only recognize a profit and loss when it is sold. We would not increase it as its value went up on the books. We would recognize the $2,350 in revenue for C. We would not recognize the $2,500 until we're 100% sure that we're getting $2,500. Not almost 100% sure. And then for employees, we'd recognize nothing. How would you value that? How important are your employees? And imagine having to adjust that value if key employees left. All right, let's discuss a simple transaction. They issue $20,000 of common stock for cash. So equity would increase $20,000 and assets would increase by $20,000. They purchase equipment on account for $3,500. Equipment would increase by $3,500 and liabilities of accounts payable would also increase by $3,500. All right, they receive $4,000 in cash in advance from a customer for services not yet rendered. You'd recognize an increase of $4,000 in cash and liabilities of earned revenue of $4,000. You provide $5,500 in services to a customer who is asked to be billed for the services. Your accounts receivable would increase by $5,500, and your equity for revenue would increase by $5,500. You pay a utility bill of $300. Your cash would decrease by $300, and your equity, due to the expense, would decrease by $300. You distribute a cash dividend of $100 to your stockholders. Your cash would decrease by $100, and your equity for dividends would decrease by $100. When we total up all these transactions for the various accounts, you'll see that the assets equal liabilities plus owner's equity or equity. So $23,600 plus $5,500 plus $3,500 equals $32,600. Well, your liabilities of $3,500, $4,000, and $20,000. Your liabilities of $3,500 and $4,000, and your equity of $20,000 less $100 plus $5,500 less $300 also equals $32,600.